rising recession fears weigh on the sector. The KBW Nasdaq Bank Index peaking earlier this year before seeing a steep drop in recent weeks. This as the big banks are set to kick off first quarter earnings season next week. Joining me now, Alison Williams, Bloomberg Intelligence Director of Research Global Strategy Team. Alison, thank you so much for joining us. Wow, what a week for financials. Just a huge amount of selling here. What do you think happens next?
So clearly the quarterly trends are going to be old news with the reports, and the focus is really on the risks ahead. The stocks had performed very well coming out of the election on lower regulatory risk. That's still intact. However, the key concern is credit risk. And that's really going to be the shift in the narrative, both in the earnings and the quarters ahead for the banks. Investors had really been focusing on monetary policy and interest rates. Now the focus is on fiscal policy and credit risk. I think a few things that we're going to see in the quarter. Again, it's mostly backward looking. We are going to see strength in trading, record trading volumes in several asset classes in March, and certainly a more active trading this quarter. However, with the other capital markets businesses, such as investment banking fees, there have been hopes for an investment banking fee recovery this year, and we think that enthusiasm is curbed, if you will. There was a strong start for the year, so we think fees will be okay for the quarter, but really the outlook is incredibly uncertain, and CEOs do not like to move ahead with those decisions when they sort of don't know what the outlook is. And so we think that the fee recovery will be dashed. Obviously, asset and wealth management businesses will be impacted again more in the quarters ahead than the first quarter, but it's really credit that investors will be focusing on.
Is there still any enthusiasm to be found within financials, particularly given, as you know, there was so much excitement around regulation and deal making getting ticked up? Is there still hope for some of that moving forward?
So from the regulatory view, I think that is a shift under this administration, and I do think that is a positive, especially if some of the capital regulations referred to as Basel III endgame could be finalized under this administration. That was really a key concern for the banks in the prior administration, just because it would be tougher for the banks to return capital. They would have to hold more capital, and it would damp returns on the business. So that is still intact. However, the credit costs, which, as I said earlier, have not been a focus for banks, are going to be a big question. And I think you could see some provisions in the quarter, and that's going to be a key thing that we're watching, because those provisions basically will look ahead. Provisions are set to the life of the loan, and to the extent that the banks are changing their economic outlook, our view is that they will probably place a higher weight on a more negative outlook. So it's too early to tell, what the outcome will be, but certainly weighting towards a higher risk scenario is going to increase those provisions, especially on the consumer side. For the banks, to some extent in the quarter, that will be offset by some of the trading strengths.
Alison, we'd love to have you back again soon. We've got a little bit more time. Thank you for coming on. We appreciate it.
Thank you.